Hi, my name is Adam Bergman. I'm a partner with the IRA Financial Group, president of the IRA Financial Trust Company. Today I want to discuss how you can avoid unrelated business taxable income. And unrelated business taxable income is a pseudo tax that's imposed on charities and IRAs, 401ks that engage in transactions that generate income in three ways: margin to buy stock, non-recourse loan for real estate, and the IRA or 401k invests in an active trader business through a pass-through entity. So let's talk about the last two. The margin for stock doesn't really come up much. Most people aren't using margin to buy stock in an IRA because you can't personally guarantee the loan anyway, so generally the margin won't be an issue because you're not going to get it. So number two, how to use a non-recourse loan to buy real estate. If you do it in an IRA, you'll trigger the unrelated business taxable income. The tax can go up to 39.6%, follows the trust rates. There's an exemption if it's less than $1,000, but if it's over $1,000, once you're close to $20,000 or so, you'll hit the highest tax bracket. So it's a very low threshold. You have to file it each year on a 990T. Your IRA would file it. The tax would come out of your IRA, not you personally. But of course, your IRA is tax deferred, or in the case of a Roth, is tax exempt. So to pay that extra tax is something that most people don't want to do. It generally changes a lot of things about the investment. It could turn a very tax-friendly, tax-efficient investment into something that should not be done with an IRA. Maybe it's better off done with personal funds. So it's very important to understand these rules. It's important to work with tax professionals, people at the IRA Financial Group. Myself, I'm a tax attorney, trained master's in tax law. We have trained attorneys, we have CPAs on site. We can help you navigate these rules. We filed hundreds of 990Ts for clients and helped thousands of clients kind of circumvent and navigate the unrelated business taxable income rules. So again, there's triggered in three ways: margin to buy stock, number two, non-recourse loan to buy real estate. There's an exemption for a 401k. So if you have a 401k under 514c9, solo 401k, for example, and you want to use a non-recourse loan, again, it has to be a non-recourse loan. A real estate, a loan that's personally guaranteed would trigger a prohibitive transaction under 4975. So you did a lot worse than triggering the UBTI tax, because when you trigger the prohibitive transaction rules, you violate those rules and you blow up your IRA and there's tax and up to 100% penalty. So you definitely can't get a personal guarantee on a loan. So a recourse mortgage is something you personally guarantee, not possible. So it has to be a non-recourse loan. And if you do it in an IRA, you're going to trigger the UBTI tax, which again can go up to 39.6% on a portion of the real estate acquisition indemnity. So it can certainly change up the tax efficiency of the deal. And third, if you invest in an active trader business, a restaurant, or even a fund, a venture capital fund that owns active trader business through a pass-through entity like an LLC or partnership, you can trigger this UBTI tax. And because close to 95% of all new businesses are pass-through entities like an LLC, a lot of times when your friend asks you to invest in his or her business, or you're investing in a private equity or venture capital fund, you may encounter these UBTI rules. And again, the tax rate can go up to 39.6%. In these instances, which is certainly not efficient, because in most cases an IRA is pre-tax, or in a Roth IRA, you're not expecting to pay tax on the income or gains. You expect to defer that or not pay it at all in the case of a Roth. So it certainly changes things up. So how do you avoid this? Well, a couple of ways. Number one, the blocker corp. So the reason most Americans never heard of UBIT is if you buy stocks in mutual funds, 99% of all public companies are C Corps. Now think of the C Corp as a big box. The income is boxed in. The C Corp pays a tax rate, whatever it is, whether it's 15, 20, 35%. And then anything left over that's dividended up to the shareholders is subject to a shareholder level tax. So C Corps are a blocker. So Apple, Google, IBM, Ford, GE, they're all C Corps. That's why the UBTI gets blocked when your IRA owns those shares or through a mutual fund. You don't have to deal with it. There's a couple public partnerships, and your financial advisor, like master limited partnerships or some hedge funds, private equity funds that are public, that are in a partnership model, your financial advisor should let you know that if you use your IRA, you could trigger UBIT, or likely would. So you can set up a blocker. So I have a lot of clients, especially if 50,000 less of profits. Currently the tax rate's 15%. It could go to 20%. Obviously, that's less than 39.6. So I do have some clients that feel that they want to do the deal and they'll pay some tax. They just don't want to pay 39.6. So they'll use a blocker and pay the corporate tax rate, which they believe would be lower than the UBTI tax rate. And they'll use that as a blocker to do either venture capital, hedge fund, even real estate with non-recourse loan. Any way that would trigger UBIT, they'll use that C card to block it. Number two is a loan. Instead of investing in a business or a venture, well, probably more of a business, you can lend the money to the business, even though you won't have the upside of the economics of ownership. The interest you get back from the loan will be exempt from UBTI. So some people that works, if they feel they're going to hit a home run with the company, they want to own it, and basically the loan doesn't work because they're not going to generate enough return. So some people say, well, I'll structure the loan that it's based off the profits. It doesn't work. The IRS isn't stupid. If it smells like equity, they're going to treat it as equity. You can't just put loan on the document and treat it as a loan. They're going to look at the terms. The loan should be a stated rate of return. It can't be based off the profits. If that's the case, it's going to be treated as equity. So that's really the two ways is blocker, use the C Corp as a blocker. You still have to pay some tax, but it'll probably be less than the UBTI tax of 39.6. Lend the money to the business. A solo 401k if you're doing real estate acquisition, then this, instead of using an IRA, if you're eligible for a solo K because you're self-employed, you may want to look at the solo 401k or a 401k to buy the real estate and then get the non-recourse loan so you're exempted under 514c9. Those are really the three ways to avoid it, or just don't do the deal, use personal money, because that tax rate, that 39.6, is quite hefty and it certainly changes things up. Again, we'd love to hear from you. The UBTI tax rules are quite complex, so you definitely want to work with trained tax professionals. Adam Bergman, IRA Financial, call us 800-472-0646. You can email us or email me. Please, love to hear from you. Adam B, A-D-A-M, B as in Bergman, Adam B at irafinancialgroup.com. Thanks, and until next time.